So what Radix did is we spent the last 18 months working with leading DeFi projects, leading DeFi developers to build a programming language that we call Scripto to make building DeFi insanely easy, secure, and fundamentally more intuitive.
All right, welcome back everybody to Altcoin Daily. My name's Austin, here with Aaron, joined by special guest, CEO of Radix, Piers Ridyard. Man, thanks for hopping on with us.
So great to be on the show. Thank you so much for having me.
For sure, and you're in New York right now for a conference, is that right?
Yeah. So we are tomorrow. We are doing Ape Radix, our event. Ape Radix, Ape standing for Alexandria preview event. At the end of this year, we have our big release. Alexandria release, which is the second release. First release was Olympia. That was our mainnet. Alexandria is our release of several exciting things, including this programming language that we built specifically for building DeFi. And tomorrow is going to be the preview of it. It's going to be the first sneak peek at why Scripto is going to be so game-changing for DeFi. And it's mostly a developer event. We've got a load of developers coming along. It's going to be workshops and stuff like that. But it's a preview of what's coming at the end of the year. So we're super excited.
And we've covered Radix on the channel before, but just to clue everybody in, can you just go over your background and then jump right into what is Radix?
Sure. Yeah. I mean, my background's sort of varied. I've done everything from sort of finance to law to sort of building consumer electronics to like mining on Ethereum. That's actually how I got started in crypto. Is I started mining when Ethereum first launched. We were literally mining like sequential blocks. If only I'd kept all my Ethereum for back then, that would have been great. But I got the bug in crypto as a result of this idea of smart contracts and like how incredibly exciting that this new paradigm for what you could do became. And that was when I got into the crypto industry, and through that met Dan, the founder of Radix, and eventually became CEO of Radix in 2017, and have sort of been building the team and the company and the community ever since.
Excellent. Look, Piers, I'm a noob. I've heard of Bitcoin. I've heard of Ethereum. I know about Cardano, Doge. Like, what is Radix though?
Sure. So like Radix is a layer one decentralized ledger. So like Ethereum, like Bitcoin, it has its own nodes. It's a decentralized network that is running consensus that you can build programs, decentralized applications on top of it. But what we've done is we've focused specifically on this area of crypto called decentralized finance. So decentralized finance sort of grew about 18 months ago. It started off with like 750 million, $1 billion under management. In the last 18 months, it's gone to 200 billion. It's actually, I just checked today, $270 billion under management in DeFi. And we built a layer one protocol specifically to serve decentralized finance, specifically actually all of the problems that we see in decentralized finance. The first one sort of everyone's very aware of, like on Ethereum using DeFi, things like Uniswap, things like Aave, things like Compound is really expensive because it's congested and the gas fees are really high. So Radix is a massively scalable platform, but we scale in a very particular way that allows us to like keep some of the fundamental properties of DeFi. Like one of these really important things is that I can call several DeFi apps all together, and I can go, right, I want a flash loan from Aave, trade on Uniswap and pay back my loan in Aave, and I want it to all happen in a single block. No one apart from Radix preserves that whilst creating massive linear scalability. And then the other side of this is we realize that one of the big things holding back the DeFi industry is how hard it is to actually build DeFi, right? Like every single DeFi project that we speak to is like, man, there's not enough developers in the space. There's not enough people who can build Solidity well, who can actually program secure DeFi, because, we've seen $1 billion of hacks in the last 18 months. That's insane. And the reason is because it's really difficult to build secure DeFi. It's actually really difficult even to architect DeFi. And it's not because there's not enough developers coming into the space and going, I'm going to give Solidity a try. It's because getting from giving Solidity a try to being actually competent is like 18 months, 2 years. And so many people drop out at the end of it because this whole experience of building DeFi is kind of insane. So what Radix did is we spent the last 18 months working with leading DeFi projects, leading DeFi developers to build a programming language that we call Scripto to make building DeFi insanely easy, secure, and fundamentally more intuitive to get to the point that you want to, right? And I was talking about this before, this idea that we've created a game engine like experience where we have this concept of a finance engine underneath the language that gives you all of the primitives you would expect in DeFi for free in the language. So you can take something like, Uniswap, which is 10,000 lines of code, and bring it down to a couple of hundred lines in code, something like Scripto.
And to clarify that, could you briefly give that analogy you gave us off camera about what they had to do for games back in the day and how?
Sure, absolutely. So when the game industry started back in like the 1980s and the 1990s, the main task that a game developer had to do was first define the rules of physics. Like you couldn't build a game and make it work in the way that you as a human intuitively understand the world works around you today without defining the rules of physics, because computers don't understand what physics is. They don't understand what a table is, and that you can't, put your hands through it easily, or that you can't walk through a wall, or you can open doors. All of this stuff that just we take as for granted, that took hugely talented people to build it, and it was like 80 to 90% of the work of building a game was just building the physics of the game. And then in 1998, 2000, and 2003, there was this massive change, this game changer in the industry called the game engine. So like the Unreal Engine first and then Unity second. And that suddenly gave physics for free to developers. And now developers could spend all of their time working on the things that makes games amazing, like the narrative and the story arc and the level design and all that kind of stuff. And it meant that, it went from being a bunch of really, really specifically highly talented developers who had a huge amount of experience and could like understand physics all the way up to artistry, to people who could sort of like, two broke guys in their dorm room could suddenly create an indie hit. And you just saw this explosion. So the games industry went from like $30 billion in like 1998 to $173 billion today. And it's projected to get to like 313 billion in the next few years. And that explosive growth is massively down to the games engine. Which completely changed the ability, the barrier to entry for people to come in and create games. And the DeFi industry is in much the same place as it was before the game industry. Like it's really hard to build DeFi because everything has to be like hand-rolled from scratch, and you're not really given anything. So you have to be a really, really experienced, like very, very technical developer to build anything in finance. And I think that we're about to see this massive Cambrian explosion that we hope that Radix is going to be part of. With what we're building with Scripto and the Radix engine.
It's pretty exciting. Is it fair to say that you describe Radix as an Ethereum killer?
Like the thing about I think that what these public ledgers have shown us is that they don't die. What I call them is perpetual motion value machines. Like once they start, they keep going. Like Litecoin's still going, Doge is still going, like Doge is going strong. Because as long as there is an incentive to keep running it, and as long as there is people who need to use it, it will continue to exist. Ethereum isn't going away. Ethereum is going to continue to exist in the same way that Bitcoin is going to continue to exist. But what we're talking about is like magnitudes of scale here. Like the DeFi industry, $200 billion. Right? The global financial industry is $400 trillion. That's over 2,000 times bigger than where we are today. Over 2,000 times bigger. That's scales of magnitude larger than the difference between the Earth and the Sun, if you want to sort of start visualizing how much difference we've got there. And so we're an invisible dot on an invisible dot in the decentralized finance industry. So no, Ethereum isn't going to go away. The NFTs that have been built and have value there are going to stay to have value. The apps that have been built there, the Ethereum itself as an asset, is going to stay. But it's just going to be less relevant as better platforms like Radix come along that make it easier to start eating the global financial industry, start bringing across mainstream finance and mainstream users into the crypto space, which is what this is all about.
And I just want to sum this up for the audience that While Ethereum and all those other cryptos you've heard of are blockchains, Radix is a distributed ledger technology, not a blockchain, but you can sell dApps. And DeFi can be built on. And a big difference here is composability. Radix maintains it while you can scale. These others don't seem to. Can you explain what composability is and why it matters?
Sure. In simple terms. Composability is this idea, specifically atomic composability, that you can do several things across several applications at once in a single block. And for the everyday user, this doesn't seem that important. So like as an everyday user, I want to go and swap something on Uniswap. And that's all I want to do. I go to Uniswap and I expect there to be price. I expect that price to be good. And I expect there to be liquidity. And I expect that liquidity to be deep, because as a user, when I go and hit Uniswap once every month, I expect that price to be as good as what I get on Binance or KuCoin or whatever, right? And the way that happens in Ethereum is because it's possible to arbitrage positions between applications, between Aave and Uniswap and SushiSwap and Curve and all of these different applications. What's moving the huge amount of liquidity that makes price great for a user when they come is this ability for arbitrageurs to come along and normalize prices and normalize liquidity positions and normalize yield between all of these applications. And they do it not by waiting block time. They don't go, I'm going to take something from Uniswap, I'm going to wait until it confirms, and then I'm going to put something on Aave, and I'm going to wait until it confirms. I'm going to take it from Aave, and I'm going to put it on SushiSwap, and wait until it confirms. And on Ethereum, confirmation time is what, 10 minutes, something like that. You have to wait several blocks before you can get rollback. What atomic composability in DeFi does is it allows you to ask to do all of those things in a single block. You can say, I'm going to borrow from Aave, I'm going to swap on Uniswap, and then I'm going to swap on SushiSwap, and then I'm going to put it on Curve, and then I'm going to take it out of Curve, the other thing out of Curve, and then I'm going to pay it back on Aave in a single block. So, the other way of talking about this is zero block time finance, right? And that is what keeps DeFi at the right price for the users that come and hit it occasionally. While that's like a small percentage of users, by volume and by importance, it's one of the most important things that DeFi does. And so Ethereum 2.0 kills atomic composability. Like Near's sharding kills atomic composability. Avalanche's subnets kill atomic composability. None of these platforms, they come along and they go, right, we're going to give you more scale. But the way that you get scale is you have to sacrifice atomic composability. And that atomic composability actually is going to sacrifice what makes DeFi liquid and well priced today. And so Radix, we were like, that's a non-starter. We have to have atomic composability. We have to be able to do zero block time finance at any scale. Otherwise, the pricing and the liquidity isn't going to be there for the mainstream users, but because they need that for them to move from their current world to this world. They need this world to give as good liquidity and as good pricing at any scale for them to want to move from the banks and the Robin Hoods of the world.
When you see people who I assume you respect, like big wigs in the crypto space, like Sam Bankman-Fried, Vitalik, Gavin Wood, and they're focusing on blockchains, like, do you think there's a big disconnect that they're not seeing, or what do you think when other people are building on different blockchains?
So no, I think that like Sam Bankman-Fried, like if you look at his interviews, he's an incredible, and Vitalik's the same, and I've seen less of Gavin Wood, but like both of those, Vitalik and Sam Bankman-Fried, both of those people are of the caliber I'd call like strong ideas weekly help. Like you see them change their mind over time. You see them go, oh, this right now, this solves a problem for me. So this is what I think is the right technology direction. But when something else comes along and it changes their idea of what is the right technology direction, you see them doing that. And like Sam Bankman-Fried, while he's super bullish on Solana, he also understands the drawbacks of it and has been seen to be critical of things like its build experience and all that kind of stuff. And Vitalik, famously continually changes what he thinks is important about Ethereum 2.0, and that roadmap has changed so many times over the years. So I think that what you essentially take the best information you have available to you. With Radix, we took the extreme position of going, we think that blockchain is the wrong starting point. I think basically if we want to get to a global financial system, a decentralized global financial system where $400 trillion can live, and a few billion people, you don't start with a blockchain as your starting data architecture, because it just doesn't work for that much people, for that much data. When you're talking of like trillions of gigabytes of data being held in a system that needs to be stateful and safe for money to be held, yeah, you need to think about your data architecture differently. So that's where we started, and it took us longer to get here as a result of that. But I think without blockchain, we wouldn't have been able to learn the lessons we have about all of the other things that are important as well. Like, so much of Radix's DNA comes from just being able to learn from the space, being able to see what was great about Solidity and what sucks about Solidity, what's great about how people are building DeFi today and what's difficult about it. And all of that has led to what has enabled us to make these breakthroughs.
So many things we could talk about. First of all, Piers, you got great energy, man. It's like dad energy or like favorite teacher energy,
I'm sure he gets that all the time.
Yeah. Oh man, I've just become old.
But I guess, something I want to know is what dApps are on Radix right now, and what dApps will there be in the future?
Well, no dApps are on Radix right now, because we're literally, we're previewing the language on which you can build decentralized finance on top of Radix tomorrow. We're releasing that language at the end of this year, and we're doing something that Ethereum didn't do, and Vitalik has many times said that he regrets not doing, which is we're releasing the language before we integrate it into our public ledger. So like he constantly, there's several times where Vitalik's been like, man, I wish we'd just released Solidity a bit later, or we wish we'd like just been able to get this functionality or this feature set into it. So we realized, like, we're building a new paradigm and new programming language. And so there's going to be some kinks that need working out. Like, we've spent a decent amount of time working with some of the leading projects and leading applications, but it isn't going to be perfect. So let's release the language in an environment that lets people test it out, give us feedback, play around with it, start building the community. Because for a big DeFi project to decide to build on any platform, they aren't just going, oh, I'm going to build there. They're like, I need to maintain that. I need to know that there is access to talent, there's access to developers, there's people that I can draw on, there's knowledge I can draw on. And to do that, you've got to start building the developer ecosystem. So we're starting to build the developer ecosystem. At the end of this year, that's when the language comes out. There's going to be a proving time for it to mature, for us to get feedback, for it to get to the point that it is insanely great. And then on Babylon, which comes out next year, Babylon is the release of our mainnet when Scripto and the Radix engine is properly integrated into it, and you can start releasing DeFi on Radix. So right now, Radix, Olympia, the public network, you can only do things like simple transactions. It's testing our consensus model. It's testing our security model. We've already got over $1 billion worth of Radix staked on the network. So we're super proud of where we are in terms of decentralized holdings, in terms of security. But yeah, there's still a way to go before people can actually build decentralized finance on Radix. And that's because we've just gone a completely different route. Gone like, nah, forget Solidity, forget the EVM. Let's go this direction instead. So same thing we did with the data model. No, it's an insane data model to pick blockchain as the data model for the global financial system. Equally, it's an insane language and execution environment to pick the Solidity and the EVM as the thing that we want to base safe money for the world. Like, no way. So let's start where it's supposed to be, start from here, and that's where we need to get to, rather than just like copying what is already in there.
I'm not a developer, so if this is a dumb question, please educate me. But why create a native programming language like Scripto? And for context, Ethereum has Solidity, a native programming language, which I hear is very complicated to use from the outside world of developers. But I know other blockchains have like integrated the programming language that already exist. So
right, so like Rust, Rust is what Polkadot is doing, it's what Near is doing, and then like a derivative of Haskell is what Cardano is doing. So the reason that we created a new programming language is because we actually created a new programming paradigm and then put a new language on top. So the most popular way of programming, there's two like big forms of programming. One is something called object-oriented programming, and the other is called functional programming. And these are just ways in which you think about building your program's architecture. What we've created is a new type of programming called asset-oriented programming, and the whole principle here is going the main class of object in your program is assets and things for containing assets. So like resources or buckets or whatever you want to call them. And as soon as you create that paradigm, you now need a programming language and a way of defining those native classes that allow you to easily describe what you want. So again, this does get a little technical, but in very simple terms, when you architect a product like Uniswap, what you want is the way that you would draw the block diagram, the way you think it would work. You want that to be as close to how you would actually program it. And in all DeFi today, none of the public ledgers actually understand what assets are. So Ethereum doesn't know what an asset is. It doesn't know what a token is. It doesn't know what an NFT is. The way that you create a token is you create an ERC20. But an ERC20 isn't just going, I want a Piers token, I want it to be 100. It's actually a full description of what a token means. So it's a little program defining a token, and then it's all of the balances for that token. So the ERC20 is keeping the balances of the token, not Ethereum. Ethereum doesn't know where the balances are. All it is then you have interfaces that are messages between these little programs that are defining every single time a new token. So every single token on top of Ethereum is its own little program, its own little set of balances. So when you look at your wallet and you go, oh, I've got this many tokens in my wallet, you don't. Those tokens don't exist in your wallet. Those tokens are balances spread across the entire Ethereum ledger. And this is what kind of makes building DeFi insane. And that doesn't matter if you're doing it in Solidity, or if you're doing it in Rust, or if you're doing it in Haskell. If that's your paradigm, where your ledger doesn't understand what assets is, and you're just passing messages between little programs that are defining what assets are, you end up with very complicated build paths and very complicated architectures. And what we've done is we've gone, no, scrap that. Instead, let's give the ledger a finance engine, the Radix engine, that means that the ledger itself understands what assets are, what resources are, what NFTs are, what tokens are, and then let's make the language just call those functions, and define all of the logic that you want around it. So now you're no longer defining what it means to be an asset. You're just going, I want some Piers tokens. I want them to swap from here to here, and then you're just typing those things out. You're not defining what a swap is. You're just saying swap for this on the condition that this happens. And so the amount of code you have to build, the amount of complexity you have to think about just massively reduces, makes it way more intuitive to build DeFi.
Excellent. I'd love to hear more about the XRD token, the native token. I think I understand how the Ether token works in Ethereum, or the Solana token works in Solana. Is your token comparable? Or please tell us about your token, how it works in the ecosystem.
Yeah, it's very similar. So like the XRD token, the Radix token, is the native token of the Radix network. You can use it to stake, and staking will earn you, I think, about 10% per annum at the moment in extra tokens, and that reward is to reward you for securing the network, because it is a delegated proof of stake network. So you can either run a node and delegate your tokens to that node, or you can choose a node. If you don't want to run the node, you can choose a node and just delegate your tokens to it. And then you also use the token to pay for fees on the network. So if you want to send a transaction, you pay a fee. And if you want to create an application, deploy an application, you pay a fee. Or if you want to use an application, you pay a fee. Now, very much like EIP 1559 on Ethereum, the new one that is creating all of the burn, on Radix, all fees are burnt. So there is, a built-in deflationary mechanism to the system in terms of the more users, the more tokens that end up getting burnt. But simply put, it's very similar to Ethereum or to the Solana token or to the Cardano token. It's the native token.
One of the things that Radix has that no other distributed ledger technology has that I know of is on ledger recurring revenue. In my opinion, There's so many dApp platforms. I've always said whoever can get the developers is probably the one that'll come out on top. Can you explain what that is and why that's such a game changer for developers?
Yeah, so like this was us sitting back and going, one of the things that public ledgers are really good at is incentivizing behavior. And the first behavior that we try to incentivize is people running nodes. tokens, right? So on Bitcoin, you run a node because you can mine tokens. And so that's created this incredible decentralized marketplace for computer power to power the Bitcoin network. And the same on Ethereum. Like if you go and run a node, you can earn fees, you can earn tokens for doing so. But we realized that was just the first form of human endeavor that you could actually incentivize on top of the network. And we realized the other thing was that the entire of DeFi is open source, and there's all of these developers who are contributing to the open source code, and like this open source like code forms the basis, is the crux of how things like Aave and Uniswap and stuff like that can actually be built in the first place. So much of their code is built on what developers before them in the Ethereum ecosystem have built, but those developers don't really get paid for those contributions. And while that's okay, you know, that is the open source code ethos, and I think it's fantastic. What we realized is that because of the way that you build decentralized applications on top of Radix, we have this concept called components. And these components, you can think of them as like little Lego building blocks. So if you're a developer, you'll be used to using Git like GitHub or GitLabs. And what GitLabs allows you to do is you go, okay, here's a library, it's got this set of functions. And then another developer can come along and go, oh, I'm going to integrate that library into my larger application. And then someone else will come along and go, oh, I really need that functionality, I'm going to integrate that into my larger application. And so the human endeavor sort of builds on top of each other, but in this very organized, structured way, you know, called Git. What we've created is this on-ledger component library that allows you to do the same thing. So if you've got a developer who has created this incredible, you know, optimization for doing automated market making like you do on Uniswap, right? But they don't actually want to build a Uniswap like that because that's a lot of effort. You've got to do marketing, you've got to deal with customers, and I don't want to do that. I just want to sit and build code. Cool. You build your code, you put it up as a component on Radix, and then those components are composable together to make applications. But what we've built into it is that those components you can have royalties flow directly to it. It's baked directly into the ledger. It's not an application on top of it. Every time you pay a fee to use the net to use an application, some of those fees flow directly to the developers who have built those components. And so what we saw here is we're like, what if we had a self-incentivizing developer ecosystem, one where the great components that are really useful to the decentralized to the decentralized application ecosystem that's building on top of Radix get rewarded and continually rewarded for the contributions that they're making to the ecosystem. So not only the entrepreneurs, the developer entrepreneurs who are building great dApps on top of it can get rewarded, but the entire ecosystem of developers trying to make the Radix DeFi ecosystem great can also get rewarded for the success of those entrepreneurs.
We actually did a dedicated video on Radix a couple months ago. I want to encourage people.
Yeah, it was awesome. Thank you.
Hey, absolutely. It was great to dive deep into it. I'm going to link it down below. We go into even more detail on all these different components. I want to finish the interview with just like big picture cryptocurrency market type questions. But first, is there anything we didn't cover about Radix? I
mean, like we've been building for a long time, so there's a lot of Radix stuff that sort of like I think is interesting and sexy and important, and like sometimes we build things like early and then like 2 years later everyone's like, oh my god, this thing is really important. One of the things that I think is really important that Radix has built that the market doesn't care about yet but will do in the future is we built this thing called Instapass, which is an optional service that any DeFi application can integrate into their DeFi, and it gives you essentially single sign-on compliance for free. It allows you to comply with AML KYC rules, where the stack is not just providing identity, it's providing a full essentially compliance service for your application with all of the regulation that's coming in, the VASP regulation, the FATFA regulation, all of that's coming in. What was really important to us is that two guys sitting in a dorm room could always build a DeFi application on Radix, regardless of what happened to the regulatory landscape. And so while permissionless finance is, such an important component of this, there is a future in 2 years, 5 years time where regulated finance on top of decentralized infrastructure is also going to be important. It's going to have to be able to play nicely. So we built this thing where we're like, we think this is important. We think this is going to matter in the next cycle. And it's already up and running. People can already play around with it. But it's for 4 years time. It's not for now because people don't care about it yet, but they will. So we're not just looking at what is necessary now. We're looking at what's coming down the line, and how can we make sure that there are no barriers in the way of this industry eating, the $400 trillion global financial sector.
I love it. I'm going to put the general links down below in the video description. Check them out. But to zoom out and now just talk big picture crypto market, man, what's your take? Where we are with Bitcoin, this market right now?
So I think that Bitcoin is still the technology flag for the industry. I think that it defines the philosophy of the industry so much, and you're seeing more and more people buy into that concept. Like, if we want the world to have a safe place for money, we want that money to have some, or that store of value to have some inherent characteristics. And it's not just, sort of the crypto crazies now. We're seeing investment banks come in, we're seeing big funds come in, we're seeing hedge funds come in. And like, my take is that institutional capital takes a long time to think about these things. I think it was already thinking about it last cycle, and we're starting to see more and more institutional money come in this cycle. So, the super cycle may happen. I'm still not sure, but I think that we may not see the end of the. I don't know that history is necessarily going to repeat it. It's a lot of people like, Christmas comes and it kind of kills everything, and like maybe January, February will be the end of the bull cycle. I don't think that's going to happen this time, but I don't know. Like, it could go either way. But I think that there's a lot of stuff that's happening both from a macroeconomic point of view. Inflation's increasing in the States. There's like this whole shock that's still yet to be paid for as a result of COVID. I think that macro trend is going to continue, and that could actually really help things like the narrative of Bitcoin going forwards.
So you think that there is a strong possibility that a lot of people are expecting the Bitcoin bull run to end either at the end of this year or the very beginning of next year? You think there's a strong possibility that this goes, kind of well into 2022?
Yeah. I mean, like, reading people like Willy Woo, who I've got a huge amount of respect for, in terms of how he does his on-ledger analytics. Like, I don't believe in technical analysis. I think technical analysis is bunk, but I do believe in fundamental analysis. And like, a lot of the fundamentals are still looking really strong for Bitcoin and as a result, the crypto industry in general.
I'm going to ask you a fun question that we like to ask all our guests. Keep in mind, this is just, this isn't make your own decisions out there, but by the end of this bull cycle, Bitcoin will be at, what's your take?
So like, yeah, again, not investment advice, certainly not telling you to buy based on this. I think there's a decent possibility for the 120 to 200 region. I think beyond that, it sort of really depends on what happens in the macro economy. Like, if there is a really bad financial crisis, another sort of like recession, I actually think that may be bad for Bitcoin, not good for Bitcoin. Like, there's a lot of people who are talking about this idea of Bitcoin being an escape, but a lot of companies, like the big institutions, see Bitcoin as risk-on capital, not risk-off capital. It's still a very high-risk asset. So I think that actually, if we have a really negative economic outlook, it's more likely to cause a depression in Bitcoin, not a surge in Bitcoin. So it really depends what happens over the next 12 months in terms of the global economy. But yeah, if we continue to be strong, and continue to see the rise in the stock market and the rise in sort of like tech stocks and stuff like that, I think Bitcoin has a good chance of going beyond that as well, going beyond the 200.
And I agree with that general sentiment. And as a reminder, gold tanked just as hard as everything else in the 07-08 crisis. It was one of the first to recover, but everything gets pulled down if the market crashes.
Right.
But we'll see. Aaron?
Yeah. Because like, a lot of what happens is like, you have funds who buy assets and then they have redemptions, especially in times of crisis. And the redemptions means they have to sell the asset. It doesn't matter how good they think the underlying is. So like, yeah, absolutely.
But in your opinion, a $100,000 Bitcoin is inevitable. It's going to happen.
No, nothing's inevitable.
All right. That's cool. That's fair. All right.
Oh dear.
All right, next, I appreciate you being so candid and playing ball with us on this. Another just fun question, not financial advice, just fun thought experiment. If you were starting with only $1,000 to your name today, how would you invest that $1,000 into the crypto market with the goal of becoming wealthy?
Interesting. Okay. Side note, do I care if I lose the $1,000? How important is the $1,000 to me?
I think it's your investable money.
It's my investable capital, but I'm not going to go hungry if I lose it. Okay. All right. As long as it's money that I'm willing to lose, I would probably concentrate on. It's a really good question. $1,000 if you're dealing with DeFi and Ethereum is not a huge amount of money because you have to pay all the gas fees, which can be massive. So it would probably still just be buying tokens on an exchange. And I would probably weight it 30% Bitcoin, 20% Ethereum, because I think those guys have got decent upside. And then I would have 10% on some of the meme coins. So I'd probably go 10% on Shiba, 10% on Doge. And then on the other ones, I would then go with the sort of the projects that I think are like strongest in the combination of things that matter in DeFi. So like community building and innovation. So like I definitely get some Aave, 10% in Aave, 10% in synthetics, because I think synthetics is underpriced at the moment, and then 10% in Abracadabra money, because I just think it's awesome.
Not afraid to take a small allocation in the meme coins. I respect it. That's
no, man. Like I think that it's that, like, what is it? The idea that the funniest outcome is also the most likely within a like highly connected social world. Like I still think that I think it's their entry level drug, and like and when the market is going up, you get lots of new entrants into crypto, and there's lots of people sitting there on their first Coinbase account and going, there's one called Doge, there's one called Shiba, I'll buy it. So I think that's going to drive it, just because $100 from 1 million people is a lot of money when it's added up and people just think it's funny.
And why did you say in your opinion, synthetics is undervalued? What is it about that?
So like the synthetics team were one of the earlier DeFi builders, and like they are one of the few ones that sort of actually properly understand traditional financial products, as well as like I call it, there's this thing I call the DeFi way of building, right? So there's a bunch of DeFi primitives that you kind of have to understand to be able to build DeFi. Some of these are things like pools and shares, like the idea of pooling things together, where you don't, like in finance, you have this concept of one-to-one product. So I will sell you a loan, and it's you have a loan and I'm the person loaning to you, right? Whereas DeFi skips straight to this secondary concept of securitization, where it's like a pool of loans. I have a pool of loans and I own a share of that pool of loans, or I own a share of that pool of assets, which completely changes how you build financial products, and it also allows like emergent pricing to occur. So like the lending rate of USDC on Aave changes moment to moment based on the two-sided market, the people who are willing to lend at that rate and the people who want to borrow at that rate to get leverage in the market. And so that percentage rate isn't being set by an individual taking a view or even an algorithm. It's being set real time by the market in terms of what's called a Schelling point at any given time. That's really important. That's a really important concept that most people from traditional finance just don't get as a starting point. And then there's a bunch of other things that sort of matter in terms of your optimizations. But then in finance itself, finance is a really robust, difficult area of human endeavor that like is really deep, and there's lots of complicated concepts. Synthetics has bridged both. They were like super early into liquidity mining. They understand the concept of like aggregated emergent pricing, but they also like have created a very complicated, from a financial point of view, financial product. And like if anyone is gonna get finance and DeFi together and start building some really interesting stuff, which they've already started with, but continue building some really interesting stuff, I think it's going to be the synthetics team. And there's been like a lot of like recent FUD around synthetics not doing much and like being a bit like, and not being pumpy, right? But I actually really back the team. I think they're great.
Piers, thank you so much for taking the time with us. I really feel like I have a way better understanding of Radix. Would you just, all the links are down below, but would you just give final thoughts for the Altcoin Daily audience?
Yeah, I mean, final thoughts for the Altcoin Daily audience. I'd say like the most important thing about this space in general is just keep learning. Don't stop at the surface. There is so much, but also don't feel like you're not keeping up. Like if you're not keeping up with if you feel like you're not keeping up, that's fine. That's just part of the industry growing. But don't be afraid to take the time. Don't feel panicked about stuff. Don't feel afraid to take the time to learn the fundamentals, because what I'd say is that having gone through several bull and bear cycles in crypto is that while it sometimes feels like it moves really quickly, actually the fundamentals move quite slowly. And as soon as you get all the way down to the fundamentals of how things are built, how you think about crypto economics, how you think about incentivization structures, like everything starts to be more simple. You start to get the shorthand where you can look at a project and very quickly work out whether or not you think it's good or not. And that comes from just taking enough time to educate yourself and be okay with spending more time researching one project than just snapping between lots of projects because you feel like the market's going to disappear and like you're not going to buy something. Don't worry about it. And the other thing is, I'd say is like, if you like something, buy it. If you stop liking it, sell it. And don't be afraid to hold long. Don't be afraid to hold long term, because for me, trading is the worst way of making money. But like just buying things you like and holding them and not caring too much about timing the market, just buying when you like them and holding them is probably the way, at least, that I have been most successful at buying things.
Links down below. Piers, thank you so much.
Thank you very much, guys.